If you're dreaming of a stress-free retirement, you have probably wondered, should I withdraw my provident fund (PF) and invest in mutual funds or the stock market for higher returns? Let's break it down without the hype with all the facts. Hi there, welcome to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. So your PF isn't just another savings product, it's your retirement lifeline. Every month, a chunk of your salary and an equal chunk from your employer gets tucked away. It grows quietly backed by the government, offering stable, predictable interest year after year. Think of PF as a slow but reliable train. It won't win a Formula 1 race, but it will get you safely to your retirement station. Now compare that with the stock market. More like a roller coaster. Sure, it's thrilling, but would you jump off a safe train and onto a roller coaster when you're headed towards a financially crucial destination? But PF returns are too low. We get it. 7 to 8% return in PF doesn't sound exciting in a world where inflation keeps rising, medical bills keep growing, and retirement could last 25 to 30 years. But here's the deal. Don't tear down your safety net just because it isn't flashy. Instead, build a second engine for your train. So what should you do instead? Let's say you're in your 30s, 40s with 10 to 20 years left till retirement. You have time, and time is your superpower. So here's a smart plan. Step number 1, understand the roles. PF is equal to your security blanket, safe, debt-based, steady growth. And mutual funds is equal to your growth engine. It is equity-based and gives you market-driven returns. You need both, not one or the other. Step number 2, add equity mutual funds for growth. You can start an SIP in multi-cap funds because it spreads across large, mid and small cap stocks, so you get stability plus growth. Or you can start an SIP in flexi-cap funds, which gives the fund manager freedom to shift across sectors and market caps based on current conditions. Why these categories? They have historically delivered 11 to 14% annualized returns over the 8 to 10 years or more, and they give you diversification plus professional management without the stress of picking individual stocks. Now step number 3, let compounding work its magic. So let's, for an example, say you invest 10,000 rupees per month in a quality mutual fund over 25 years. So at an average return of 12% per year, that SIP could grow to over 1.6 crore. That's compounding at work, like a snowball rolling downhill, getting bigger and faster with every turn. The earlier you start, the more powerful the effect. Meanwhile, your PF continues to grow silently in the background, offering guaranteed capital preservation. So step number 4, balance your portfolio smartly, which is asset allocation. If you want peace of mind and high returns, then asset allocation is your best friend. So here's a sample split for long-term retirement planning. You can do 60 to 70% in equity mutual funds for long-term wealth creation, 20 to 30% in debt instruments like PF, PPF for safety and stability, and 5 to 10% in liquid funds or short-term debt funds for emergencies or short-term needs. Tailor this to your age, risk profile, and how close you are to retirement. The right mix reduces stress during market crash and ensures steady progress. Step number 5, get professional guidance. You don't need to figure this out alone. A certified financial planner, a CFP, can help you create a retirement roadmap tailored to your life goals, rebalance your investments as markets move, and help you stay calm during downturns and avoid emotional decisions. Because planning for 30 years of retirement with DIY guesswork, that's not a risk worth taking. But can't I just withdraw my PF and start fresh? You can, but should you? Remember, yearly withdrawal of PF leads to stopping compounding on your safest asset. It triggers taxes because if you have worked less than 5 years, and it also reduces your retirement cushion, forcing dependence in later years. It's like selling your umbrella just because it's sunny today. Sure, you get instant cash, but when the financial storm hits later, what will protect you? Now, what are the final insights we get from this video? So withdrawing your PF to invest in mutual funds might feel bold, but it's often short sighted. Instead, preserve your PF as your non negotiable retirement base and accelerate your wealth through equity mutual funds and balance both with a clear asset allocation strategy. This way, your financial plan doesn't just survive, it thrives. The goal isn't to pick between safety and growth. It's to craft a life where you can enjoy both. So, are you ready to create a personalized retirement plan with the right balance of PF and mutual funds? Then click the link in the description and book your free consultation with our certified financial planner today. So, let's build the retirement you truly deserve, secure, stable, and full of possibilities. And if you find this video interesting, give it a like, share, and subscribe to our YouTube channel. Thank you for watching.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.